So we got done with financing. So you got a pre-approval from the bank. Now what? Now you're gonna get the property, right? Go talk to F&M. They're gonna hook you up, or the hard money lender next door. Anyways, so here's what I want to focus on today. I want to focus on three things. One of them being where I think your money is going to do really well in the next about 7 to 5 years, and that is Waynesboro. I also want to talk about new construction as a good tool of investing. And I also want to talk about short-term rental tax advantage, which probably a lot of you guys heard about already. But I want to talk about that a little bit more, also based on buying a short-term rental, cash flowing it as a short-term rental, and also using the tax advantage. So, Waynesboro. The Waynesboro aspect came to my mind when I was doing an open house in Waynesboro on a house that was around $520,000, and every person that walked through the door, I asked them where they're from. They're like, "Oh, Charlottesville." I'm like, "What are you doing in Waynesboro?" They're like, "Hey, Charlottesville is becoming very, very unaffordable, so we're moving out this way." So the stats I pulled up from 2010, they had a 15% increase in population. So they're growing population. This stat is what I want you guys to focus on when it comes down to Waynesboro. People that are working in the city versus out of the city, that has decreased from 35% in 2002 all the way down to 20%. So a lot more people are moving into Waynesboro and working elsewhere. These numbers also have been affected by working from home and stuff like that. But we're seeing a lot more Charlottesville people moving down that direction, especially with the new plant that they're building for Northern Grommet, which I think is already operational. I was talking to someone about it recently. So the difference in purchase price for Charlottesville residents and Waynesboro residents is huge, as you can tell. So average home in Waynesboro is around that $275-ish range. Average home in Charlottesville is through the roof. And all those people are going this way. So that's where you get the rental incomes. This is where you get the appreciation on the properties. Now, why I say Waynesboro is going to be good in about 7-10 years, I believe that they're about 7 to 10 years behind Harrisonburg. They need to clean up their downtown. They got to have a little bit better infrastructure. But if they manage to do that, I think they're going to do really, really well. Some more numbers about Harrisonburg. As you guys all know, we live here. Harrisonburg has been awesome. The rents has been very, very steady here because of the GMU influxes that we're seeing. There are rumors out there, correct me if I'm wrong, but I heard that GMU is trying to increase their people they're bringing in by a good bit in the next couple of years, based on the fact that they're building the link. So I don't think everyone is going to be able to be. The link is the project they're building downtown, where the funeral home is located, right beside the public building. So Harrisonburg is number 5 fastest growing out of 38 cities in the whole Virginia, taking in a lot of population and a lot of people coming from Northern Virginia. We're seeing a lot of that. So rental markets have been pretty strong in Harrisonburg and Waynesboro. They're moving around about the same pace. Waynesboro is a little bit faster, just because I think they're on that lower bracket. So also, if you compare it to national averages, Harrisonburg is a lot closer, maybe a little bit above. But Waynesboro has a lot more room to grow. So I think that in the next, again, 5 to 7, I would say 7 to 10 years, we'll see a big blow up in Waynesboro. So new construction.
Oleksii,
Yes.
can I ask a question before we move to the
Yes.
next one? What about supply in Waynesboro? Very interesting, but one of the things even in Harrisonburg is running up against supply. Is there supply in Waynesboro?
So
Or is it to build?
they're constantly building. There's definitely homes out there to buy in Waynesboro, more in my opinion than in Harrisonburg. there are restrictions down there. Waynesboro and Augusta County restrictions to build are a lot less. So we're seeing a good bit of construction down that way. D.R. Horton is building a lot of townhomes down that way. Evergreen, I think they're called, homes, building a lot of townhomes down that way. So there's definitely a good bit. And I think Ryan Homes just went in there as well. There's
Ivy Commons, correct?
what?
The Ivy Commons development for Ryan.
Yes, yeah, that one. I thought you said like no comments for Ryan Homes. I'm like, oh, hold on. I'm like, oh, like we're not gonna go there, Evan. That's your presentation. I don't respect you. Anyways, yeah, I don't want to get sued, so I'm not gonna say anymore. Yes, does that answer your question?
Yeah, it sounds like it's getting built up.
It is getting built up, yeah, and that's another reason why I think it's behind, is because the big builders that have been here already, like Ryan Homes, like D.R. Horton, like Evergreen, we're slowly starting to see them pop up in that area, which D.R. Horton got down there fairly recent, as well as Ryan Homes that just went into Waynesboro. So I think that's a really good opportunity. Why I say new construction is why. Okay, full disclosure, I just love new construction. It is what it is. I think that renting a new construction home is a lot easier. That's one. Second one, if you do decide if you can build your rental, I see all of your bunch of builders over here. So as you guys know, and others will know as well, that you can come into good bit of equity if you're partnering up with a builder to build a home, as well as you can choose the finishes. So for example, as a lot of people know, if you put a carpet in a townhouse, that carpet is gone in a year if it's a rental, if that, right? You can choose your finishes, and you can make sure you put the finishes that are going to last a long time. So new construction, good. You can also find a way to possibly partner up with a builder to build something spec, sell, as Jared is nodding at me right there. There you go. Short-term rentals. Been getting a lot of slack, recently. In our area, which we'll talk about. There's some restrictions in Rockham County. Somebody was asking that question. I don't remember who's. Oh, Evan was. Yep. So the cool part about short-term rentals nowadays, since last year, with the one beautiful bill. No, I tried to. Trump impression didn't work. Yeah. Ben, can you cut that out, please? Okay, thank you. So, gotta be 7 days or shorter. So you gotta participate in it, you or your spouse. So for example, it doesn't have to be you. You have a full-time job, you have a spouse, they get a real estate license. You really don't have to get a real estate license, but that's easier to prove to IRS. And they manage the Airbnb. And how many of you guys here work on W-2 or 1099? That's probably everyone, okay? Out of everyone here who has an S-Corp, like 1, 2, 3, 4 people. So for everyone else, you can use the depreciation, bonus depreciation. So in a year, you can wipe off your tax liability. Quick disclaimer, ain't a CPA tax advisor. Check with them. Just something for you to look into. Again, don't want to get sued today. Maybe I'll have to call Chris about insurance sooner than I thought. But yeah, very, very good vehicle. There is, and especially in Massanutten, I wanted to bring these numbers in because people say, hey, Massanutten is oversaturated with short-term rentals. And that's true. That's true. But what I wanted to show you guys is the annual revenue has been pretty good on those, on average. They're renting out only for 36% of the year, which we're seeing because of the seasonality of Massanutten. Why it's good to get a short-term rental Massanutten is because you get skiing, mountain biking, and then you also get the JMU events. A lot of people I know that rent out in Massanutten for over 10 years already just because they're used to it. So Massanutten is great. Very important to have a good listing, or somebody that does it professionally, or a good listing, good photos. Call up Ben to get good photos and videos done. I don't know if you can do videos, but photos for sure. because the listings that do a lot really good are usually the very professional listings, and they get the highest daily rates on Airbnb. And then sales in Massanutten, which is really interesting. I always see, 1.2 million, $1 million houses in Massanutten going up and going, getting sold in 2 days, just because of the new depreciation and the fact that they're performing properties. So you can get an Airbnb. Let's say you get a property in Massanutten, you flip it, put a good listing on it. You can sell it for a lot more, not because you're selling it as a real estate. You're at that point selling it as a business, a turnkey for someone just get in, claim their tax depreciation. That wealthy doctor that works at RMH, they're gonna want it, because they don't want to put any work into it. So yeah, the short-term rentals sell on average 11 days shorter. Quickly about regulation on short-term rentals. Nothing to be worried about in Rockham County. Pretty much all they're doing is you got to get a permit, at least for now. Got to get a permit. If you're on the septic, you only can have 2 people per bedroom, or pretty much 2 people per bedroom that is perked. So for example, if your septic is for 2 bedrooms, you can have 4 people. So you can advertise it for more. I don't think they're going to really go around and knocking on doors. Cut that out too as well, Ben, please. But pretty much you can't advertise it. Then if you're on public water and sewer, you get 2 people per bedroom and then four more on top. So all the Massanutten properties are probably going to be fine. You also got to have someone within 2 hours of response time if, as they say, crap hits the fan. So pretty simple. I don't think a lot is going to change. They're just you're going to have to pay $200 to get a permit, and they're going to start collecting some taxes because that's what government does. Cut that out too, please. So yeah, I think being in having new construction, having a short-term rental in our area is a good idea. Again, how long a short-term rental market is going to hold, I don't know. Another market for you guys to look into is Bryce Resort. It's definitely not as nice. The roads are crap. They just are. But the property is a lot cheaper and they're still renting out at a pretty good rates. So yeah, that's all I got for you. Thank you so much. Any questions? Don't ask them because we're going to do it at the end. Evan. Perfect. Thank you.
Oh, there we go. All right, so you've secured financing from F&M, and then you've targeted a property with Oleksii. And then you need to figure out, are you going to get an inspection or not? I'm a little biased because I own Advantage Home Inspections. And just a quick thing about me, I have 10 years of building construction experience. I worked in the commercial side for Connier for a little while, and then I've been a real estate investor and landlord since 2018. But, so why should you get an inspection if you are doing a commercial or real estate investment? There's 3 primary reasons. You get more negotiating power because you know more. You can protect your returns because you have prior knowledge, and then you can buy with confidence. So, like I said, knowledge is power. When you know the problems in a house or a commercial property, then you can bring them up in the negotiating table, and you can potentially get credits, you can get things repaired. It allows for you to have more tools, and it's certainly better than just going like this and then hitting the trigger. Also, there are people around here that have lots of construction experience, but if you reach out to an independent person and get it inspected by a third party, then there are other tools that come into play with that as well that you have an advantage of. Sorry, I thought this was on a different slide, but the primary advantage of having a third party is that if you find something that is significant, then the seller must disclose that. If you find something and then you walk, then that person must present that to future buyers. So if you find that a property, let's say it's a commercial warehouse and it's been there for 70 years and they insulated all of the pipes in asbestos, that's a significant safety hazard. They can't just sweep that under the rug and hope that somebody else doesn't know about the asbestos. if you have it on a Virginia State home inspection, they have to give it to a potential buyer. So it's in their best interest to continue to work with you. Nothing looks as bad as seeing a property go under contract and then have it removed during the inspection period, because then someone knows there's something wrong with that property. So it's in their best interest to continue to work with you so that you can maximize your leverage. And then just to give you an idea, this is not the same property on this point that I was talking about, but I have had people negotiate 25% off of their, not the listing price, but the agreed upon price after the negotiations. They're able to negotiate down further on their investment property. So the other thing that you're doing is you're protecting yourself. When you get a Virginia State home inspection, it's going to have all the different issues that I was able to find while being at this property for 2 or 3 hours. And it allows you to either plan ahead, determine that it's not something that you want to do, or figure out how you're going to end up with more money or bring more money to the table so that you can handle these things. If you don't know about these things, or you miss something, like again, I'm speaking to the people who are in building and construction, like it's always good to have a second set of eyes, because if you miss something, it can be really costly. A good example of this is this little critter right there. That is a bat. If a bat is in your house and it enters the living space and you cannot identify or confirm every single moment that the bat was there and that it did not touch you, then the government recommends that you get a series of rabies vaccines. The first one is required to be done in the emergency room. You cannot get it anywhere else in Virginia, so it's automatically an emergency room visit. And then there's like 3 or 4 more that you must go to at exact times, and if you miss one, you have to start the course all over again in the emergency room. And then you have to pay for someone to mitigate it, which starts at $5,000, and depending on how much guano is in the house, you have to pay to remove the guano and then re-insulate the attic. So these little guys can cost a lot of money, and that's just one example of if you're not planning for that, or you miss the bat poop, then you're out tens of thousands of dollars on this investment property. And then the last thing is you can buy with confidence. So you don't have to necessarily avoid the house with the bats. You just have to make sure that you either have money set aside for that, or you make a better idea is to make the sellers deal with that before you take possession. An inspector allows you to make informed investment decisions, and then you can be able to take care of things as they happen, or take care of things before they get any worse, like this really bad flashing, which I could stick my fist down. So why would you want to choose me? It's a little bit of a sales pitch, but also I think that I really can bring some value to you as an investor. I've been a landlord for 8 years. I speak the language, I have my finger on the pulse, and I know what's important to people in your shoes because it's also important to me. Another thing is I offer consultations. Say you don't have time to physically walk a property, but you still want like a pair of experienced eyes. You can hire me to go out. It will be reportless. It won't be technically a Virginia State home inspection, but then I'll either give you a phone call or I'll send you the 100 pictures that I took. And unlike a Virginia State home inspection, I'll provide you with my opinion as an investor. Hey, these are the things that I'm seeing. I think this is a total rebuild, or like this is pretty turnkey. If you paint it, it'll do you really well. So that's something that not a lot of inspectors also offer, but that's something that I offer exclusively to investors. And then the other thing too is I know that there's a lot of one of the things the market is doing right now is tightening up the window for inspections, and I have people schedule, then put a contract on a house, and if they get it, then they continue with it, and otherwise they cancel. And I don't have a cancellation fee unless I'm in the car on my way to the inspection. So I have a lot of flexibility and availability. And then lastly, the thing that I think sets me apart is there are things that I use that other inspectors don't use. I use drones. A lot of people around here are resistant to that. I have an always-on carbon monoxide detector, gas sniffer, which a lot of people also don't bother carrying, and then a thermal imaging camera. And then there's some more stuff about me, which I don't think is important, but the last thing I want to talk about is something that brings more value to you guys. So if you are at a property, what are 3 things that you need to be keeping an eye on when you're there walking the property? So the first would be large appliances, not like a fridge, but in HVAC, water heater, electrical panel. You need to figure out how old these systems are. A lot of them, especially if they're electric, they're either going to work or they're not going to work. And you go based on the law of averages. So if you have a water heater is going to last 8 to 12 years. Gas furnace is going to last probably 20 to 30 years. A boiler is going to last 30 plus. And so what you do is you take a picture of the data plate and then you look it up either there or when you're at home, and there's a website I think called buildingintelligence.org, and every single manufacturer has a code built into their serial number that tells you how old the thing is. A lot of them will have it on the data plate, but not all of them. And so you can make an informed decision based on how old that appliance is. So, this water heater is 5 years old. It's about halfway through its useful life. This boiler is from 1963. I really need to make sure that that was actually a sticking point on a deal I was going to do. I had to walk because they didn't want to replace the boiler from the Kennedy administration. So that's the first thing. And then the other thing too is something that some people might not know. Home warranties, which are typically available for individual houses. Same thing with primary mortgages. They treat quadruplexes and below as single family homes. And so you can get an investment property. A company like American Home Shield won't care that you're not living in it. They won't care that it's a quadruplex. They will give you the same rate as someone who's just living in a single family home. And it covers all 4 HVAC systems, all 4 water heaters, all 4 any electrical issues. You're covered by that. Second thing would be class action lawsuit items, something like stab lock panel, polybutylene pipes. These are things that are that caused problems in the past or continue to cause problems now. And you have to kind of be aware of them. You can reach out to me after this, and I can kind of give you some rundown of some things that you should be aware of. And then whether or not the big takeaway is not whether or not you feel comfortable, it's whether your insurance feels comfortable or not. And so what you do is you call on a line that's not your phone and you say, hey, I just bought this house, it has this thing, would you guys insure it? And for example, some houses will not, or some insurance companies will not insure houses with knob and tube wiring if you're doing commercial. And that's something that I ran into. I had to go through 3 or 4 insurance companies before I was able to find one that would take my business. So you need to be aware of that when you're buying a property. And then the last thing would just be safety hazards. They can also be class action lawsuit items, but something like an asbestos, mold. And so you have to be able to identify those things, determine the exposure. So the example would be if you have vinyl asbestos flooring in a closet, it's only in the closet, and the closet is going to be locked because it's the utility closet and you don't want your tenants in there, you're going to have pretty low exposure. But if you have vermiculite insulation and you are going to have, the tenants are going to store stuff in the attic and come out every week or come up there every week to get something out, that is a significant exposure because they're going to breathe in that asbestos insulation and they're probably going to get cancer. So you have to determine the exposure of that and then figure out how that plays into your calculus as you negotiate and whether you pull the trigger on the property. So thank you very much for your time, and I'll look forward to taking questions later.
Thanks, Oleksii. Since we've done such a great job keeping track of time, I have negative 10 minutes to do this presentation. I will say that to reframe this, you should probably talk to a financial guy before you get into real estate investing, just so that you know what you're getting into. So I should have gone first, Oleksii. But it's a pleasure to meet y'all. My name is Kyle Glenn. I'm the owner and partner at Glenn Financial, a wealth management firm here in Harrisonburg. And if you've ever met a financial advisor before, you probably know what I'm going to say. Stock market investing is superior than real estate investing. But I will caveat that both ways, real estate investing and market investing, are great methods to build wealth. You just got to know what you're doing, and you got to treat it like a business. And data shows that. This chart to the left here is Federal Reserve data for Rockingham County specifically that shows the median listing prices of homes over the last 5 years, creating a 39% increase. And we've seen that. Either if you own real estate currently, you sell real estate, or you're looking to buy, it's a hard market to get into as a real estate investor. So the core question here is, how does real estate play into your financial picture? The only thing passive about real estate is the way that it's taxed. If you really want to make money in it, you've got to put blood, sweat, and tears into it. And so our firm uses a framework to help clients guide decision-making processes called the ALIGHT framework. And what that is a acronym for assets, liabilities, insurance, taxes, and estate, which gives a comprehensive view on how to make a decision. Because of the limited time here, I'm only going to focus on assets, taxes, and estate planning. Because most of you are real estate investors or are familiar with the process, we're not going to talk about net operating income or cap rates, as that's kind of more commonplace. You should already know what that means. But specifically, I want to focus on how to view real estate as an asset in your overall wealth portfolio. This chart here is showing the nominal compound annual growth rate, that blue line, of real estate in the state of Virginia over the last 50 years. The average compound annual growth rate nominally is 4.82% over that time period. But if you adjust for inflation, the real compound annual growth rate is only roughly 1%. So real estate is not necessarily an inflation hedge for your portfolio. It barely keeps up with it. How does that play into the chart that you just seen? Well, while listing prices have increased by 39% over the last 5 years, so has inflation. So typically, listing price is a gauge to how inflationary environment is in the marketplace. What this does not show, and probably the red flags that's going off in your brain, is income production off of properties as well as tax benefits from properties, which are the two primary reasons why someone would buy real estate. Whether you're a buy and hold rental owner or a quick fix and flip, real estate can absolutely be a form of wealth generation. But for rental owners, you need to think about rental real estate more so as a dividend-paying stock or a fixed income portion of your portfolio that produces income for stability. Over this same time period, rents have not decreased once over the last 50 years in the state of Virginia on average. Name of time, even 2008, rents did not go down. It was very resilient. Another benefit to adding real estate to your portfolio. The main question here is, how much do you need in terms of your percentage of net worth to be held in real estate? Because real estate is a relatively illiquid asset. You can't pull $50,323 from your real estate account as you could a taxable brokerage account. The next thing, don't want to give it away. Does anyone know what the best, does anyone see that? If you saw it, don't answer. Does anyone that didn't see the slide know what the best tax strategy for real estate is?
Cost segregation.
Cost segregation is a great one. The best strategy is to die, right? Which is not my recommended strategy, but I know real estate investors as well as investors that have highly appreciated stock positions that will never sell their position because they are so deadly afraid of taxes that they would rather die and give that to their kids or to their spouse rather than realizing that capital event. So every investor is eventually going to exit from their investment. I primarily work with business owners who are looking to sell their business as part of their retirement plan. They never think of exit planning as a present tense aspect of their investment strategy, but it should be. Especially, you should know how you're going to get out of a position, or at least have a semblance of a strategy there. So what I want to present you is two different tax strategies on how to exit from real estate. Because you will have three universal risks. Someday, I know it's relatively young crowd. I mean, the only person without hair here is Ben. But so it's a relatively young crowd, so this might not hit as well, but you will reach a day where you no longer want to deal with the hassle of real estate. Or your spouse does not want to deal with it, or your kids don't want to inherit it. There does come a day, I had a client that sold $15 million of real estate for that exact reason. Took the tax hit, and now he's sitting on a great investment account. The main purpose here is how do we get out of a position in a tax efficient way? The first strategy is depreciation harvesting, and this is best suited for you investors that have a semblance of properties over a lifespan. Maybe you've bought properties 10, 15 years before, and you've recently acquired new ones. Those 10 to 15-year-old properties are near the end of their depreciable life cycle. You're not going to create a significant amount of depreciation at that point. What you can do is, instead of 1031ing that specific property, sell your older properties or your headache properties while creating heavy depreciation on your newer properties. That can help to offset the tax burden that you'll receive on the capital gains, as well as the depreciation recapture that you'll receive if you were to sell the property. Why would you do that? The main reason is to create liquidity in your account, because whether you own a business or real estate, liquidity is a very important thing to have in case something were to happen. Now, this isn't a perfect strategy. I mentioned it's not a perfect dollar for dollar tax reduction if you were to do this. But what do you do with those properties that you just purchased that you're depreciating heavily? At some point, you're either going to have to sell it, you're going to have to die, or you'll have to 1031 it into something else. So the second strategy here is a 1031 exchange into a triple net lease. And this is specifically for you single-family home owners or your multifamily who have headache tenants, want to keep real estate as part of your investment portfolio, but don't want to have the headache, or don't want your wife or whoever it might be to have the headache. By transferring this into a triple net lease, the tenants are taking care of most of the burden of maintenance, repairs, taxes, all of that. The problem here, and where to caution you, is low cost adjusted basis real estate that you're 1031ing into a triple net lease is not going to give you a lot of room to depreciate further. And so all of the income that you're getting off of these rentals are going to be straight income to you, which, I mean, no one's ever gone broke getting an income. But it may keep you in a higher tax bracket and have higher tax exposure over your lifetime with a strategy like that, because as you know, the way that real estate is taxed, there's not a whole lot you can do other than depreciate to keep that off your tax return. It's not active income, so you can't shelter it through tax advantaged accounts and the like. The next step is to answer that phone call. No. The next thing that we look at is estate planning. In the state of Virginia, real estate does not have a transfer on death deed that is automatically included in real estate. So how do we make sure that your assets go to your beneficiaries the way that you want to? By default, it's either going to go by your will. If you don't have a will, it's going to go with whatever the state and county determine. What that process is called, if it goes through the will or through the state, is called probate, which means to seek or to find out. They want to determine who you intended to give this property to. That costs about $1 for every $1,000 of estate value. So you can easily create a pretty significant probate expense to your estate if you don't set it up correctly before you pass away. Probate is also a public process, meaning that it goes through the court system. So if one of you were to pass away, it goes through probate, I can figure it all out and give myself an advantage if I'm looking to buy that piece of property. Also, I mean, it's just not fun having everything public. So one strategy that we implement with our clients is a revocable living trust. The benefit here is that it bypasses probate, it creates privacy for the individual, but it also can create in the trust documents an agreement with the trustee of the trust, which is typically while you're alive yourself. When you pass away, you can nominate someone to manage those trust assets. to then go find professional management for your real estate assets. If you desire to keep those real estate assets in your estate for the benefit of your spouse or your children, or to give a mandate to that trustee to then go sell that to create liquidity for your estate and for your beneficiaries. But the greatest benefit here is that it's completely revocable, meaning that if you buy and sell real estate during your lifetime, the trust can account for that.
Hello everybody. Let's see, I'm gonna slide this over because I'm a little bigger and I'll make sure everybody can see that. So yes, we got our lending from F&M. We're set, we're buying something, and then we're gonna get it all locked up and everything from Evan, and now we're gonna insure it and make sure that your investment is protected, you know. So I'm Chris, I'm with LD&B insurance here locally, not F&M, that's these guys. And so I'm gonna just talk a little bit about insuring your investment properties. So let's get into, let's see here. All right, so why do we need insurance? I think everybody knows to protect your investment, or if something were to happen unexpected, you're looking to recoup some of those funds. Little did I know I was going to learn a little bit about insurance as a kid and how it works, because when you're talking to your parents and you're like, hey, I want to go to this event with my friends, can I go? And they're like, we'll see, maybe. And that's usually the answer you're going to get from an insurance company. The biggest question you want to know is, am I protected? And the answer is, we'll see. Maybe, it depends. So insurance can get super complex into the nitty gritty as far as just exclusions and coverages and, you know, how did this happen? And so one of the things I see with commercial investors and people is that they're hesitant to tell the insurance agent everything that's going on. One, because they want lower premiums. So that's obviously the goal, to keep your insurance bill down. But what you're risking is setting yourself up for a situation where you're not going to be covered or a claim's going to be denied because you didn't specify that, hey, when I'm doing this renovation, I'm going to store all the appliances outside in a portable unit, and that gets robbed or damaged or burns down, and you didn't let us know, and that's an exclusion on off-site storage that you needed to tell the insurance about. So there's a lot of those things. I put a lot of information in these slides just so you can have a look at it and be aware, because as insurance agent, my job is just to make my clients aware of all the risks that they're involved in, and even some of the risks that they don't perceive. And what you guys do with that is your decision, but I made you aware that you could be sued in this situation, or you could be liable or not pay back in this situation. So, you know, on the first side, we're just talking about some of the reasons we want to do this. Prevent a catastrophic loss. You've put a lot of money into a project, and so that's a risk. Ensuring your business can continue when an unexpected event happens, and, you know, you get sued for $2 million, a lot of businesses close when situations like that happen. So you want to try to ensure your business can continue. Legal, financial risks. There's a whole bunch of things that go into when we're talking about specifically real estate and investing. A lot of new investors, should I say, and even tenured and experienced investors typically don't think about all the legal ramifications that are involved as far as, you know, equal lending and renting and non-discrimination. And so you can be sued for all those things. And the question is, do you have coverage in your current insurance policy to protect you when you're sued or settle, or to cover you for legal expenses to defend the suit? And so those are some things to think about. Let's see here. Some misunderstandings, misconceptions, you know, is just like, you know, full coverage, or I'm fully covered in a lot of things. And if you don't have an agent that you really have a conversation with, there's a lot of exclusions that are in every single policy. And, you know, it could be just a simple situation that you think you're covered and you're not. Your value and what you're listing, what you're telling your agent that your value of your property is versus what it actually is. And even after repairs and stuff, you can have some co-insurance penalties, and I'll talk about a specific example about that later. And then your LLCs and whatnot, just also consulting with businesses a little bit too, just to make sure they're properly covered in some of those structures and how they're operating. And renovation legal risks. There's misclassifications that happen a lot of times with whether the property you're renovating or purchasing may be vacant, or whether it may be partially occupied, or just different things need to be given to the insurance agent to make sure it's classified properly, because that could cause a denial in your claim if you're saying it's vacant and it's not, or you're saying it's not vacant and it is. And so those are some things to be aware of. We talked about a lot of this in the other slide a little bit. Let me see. Yeah, and then when you're talking about also construction, there's just some, things to be careful about, builder's risk and policy setup mistakes. One of the things I was talking about is just like, where material may be stored, how it may be stored, all those things you want to tell your insurance professional, because that can make a difference in whether a claim is covered or denied, or whether you have off-premise coverage specifically for tools, what the value of that is. If it's expensive tools, are they itemized, or details such as that. Let's see. All right, liability. Everybody knows about this, slip and fall, my back hurts, I want, $200,000. This is your rental property, you got to pay. So one of the things that we do, or at the firm, and I do, and should be happening with conversations with your insurance professionals, is part of the insurance and risk management process is actually managing your risks and making sure that your properties are clean, your rails aren't shaking, and just common sense stuff. But it could fall under negligence depending on how long it's been that way, or what the complaint is, or a lot of times you can get sued, and even if it's a frivolous suit, that's money you got to spend to defend that. So there's a lot of things that can be covered and not be covered. And again, there's so many specifics that go into insurance. And so I could list a million examples here, but I just want to give you guys a high level thing, something to see and think about. So another thing to discuss with your insurance professionals is your limits. So a lot of times that's just such like an unknown thing. Like, how much coverage do I need? Oh, $1 million. Oh, that sounds good. But the question is really, what is the typical lawsuit or settlement in that specific area and what you're dealing with? So yeah, $1 million may sound like a lot, but if the average landlord settlement is 1.5, well then that's not a lot. So really diving into what you're doing, whether you're just a regular investor or whether you're actually building homes, there could be some different liability, and I have some examples I'll give at the end of just specific case studies and some amounts, just so you guys have that. But role of umbrella policy, a big misconception that I've talked to a lot of people is just like, all right, I got this insurance, there's all these coverages, it's way too expensive, but whatever, and I'm gonna get an umbrella and that's just gonna take care of everything and I'm good to go. I got a $2 million umbrella, so I'm good. Well, no, that's not exactly true, because an umbrella is only extending underlying coverage. So if you have basic property coverage and you're covering all your tools and you got your liability down, vehicles, and you don't have cyber, but you bought an umbrella for $2 million, and now you get ransomware and they want, $500,000 to release your software, you're not covered for that. And you're looking like, well, I have a $2 million umbrella that's supposed to cover everything, but it only extends underlying coverage. So what that means is if you had a $100,000 cyber policy and then you got hacked and ransomed and you needed to pay $500,000 and you had a $2 million umbrella, it's going to extend now to cover the 1.5 that's need, like you have 1.5 left to cover with that area. So just remember, umbrella policies only cover underlying coverage. It doesn't just add this, blanket cover all. And it just talks a little bit more about it. I just elaborated in the last slide. So underinsurance and coinsurance. Do you guys have any idea what underinsurance and coinsurance is? Anyone? A little bit? Okay, so you have a property and it's worth $1 million, but you get a quote from company A and you're like, I don't like that number. It's $20,000. I'm not paying that. It's covered. So you call company B and you tell them it's only worth $700,000. And, they accept it and you pay or whatever. So you have a claim that actually comes up and it's a small claim. So maybe it's like $200,000. So you're like, oh, cool, I'm covered, $200,000, I have $700,000 worth of coverage, good to go. No. So what happens is you're gonna get penalized. Yes, because depending on what your co-insurance rate is on your policy is how much that you have to have at minimum. Because they do give you some flexibility if you've underestimated your value. So in a situation, if you have $1 million property, if your co-insurance is 80%, let's say, you have to have $800,000 worth of coverage. Otherwise, you're gonna get a ratio, depending on how much coverage you actually have, that's gonna go against that 200,000 suit. So, Oleksii.
Oh, sorry.
Oh, okay. Gotcha. Yep. So it's going to be prorated based on a percentage. So that's just something to investigate. If no one's sure what your co-insurance percentage is, just check. Because there are situations where some carriers want 100%. So it could be a real issue in a claim if something were to arise. And then here's a specific example. So it just says what I was just saying, and it's going to cause you to come out of pocket to cover the expenses. I got the warning, so I'll speed this up here. Some other things just to be aware of is endorsements and penalties by misvaluing your property. So you really just want to pay what your property's valued at. Review this with your insurance agent because, again, if you've listened to Oleksii and you've bought in a really great area and your property's doubled in value in the last couple of years and you haven't changed your insurance, you're having that issue right now and you just don't know it. Okay, yeah, it talks more. I was just giving more information about builder's risk, renovations, making sure you're having accurate coverage, telling your insurance professional everything, having a really detailed conversation, and then just legal appliances. The number one cause of insurance costs rising, premiums rising, is litigation. Everybody's suing. People are going for what they call nuclear verdicts. So it's just a lawyer coming up and saying, hey, what's your limit? All right, that's what we're suing for. And it's not right, but it's happening. And so that's one of the biggest causes of insurance premiums going up. And that's it. Just these are some of the things that I personally deal with commercial properties. I'm licensed to deal with personal as well.